The S&Ps have slid lower in January, boding badly for the first quarter of 2025. Today is January 12th, and we have been looking at the likelihood of a January rally, which has not yet started. And we expected a low on the 7th, which is coming in late. However, we're not surprised by that because the 147-week cycle, which was one of the patterns we're looking at, actually has kind of a choppy sideways period between the 7th and the 13th. And the market hasn't gone much lower either. It just went a little bit lower than it was on the 7th. Also, we were not surprised at all because the MBT, one of our techniques that we teach, was clearly saying the market should go lower. It is not a timing technique, so it doesn't say when, but it was indicating that there was an imbalance in the momentum that had to resolve itself getting below 58.20, and now the target line has actually gone even lower, so it's conceivable it could break 5,800 and still manage a rally after that. So it's possible the next few days, or possibly on the 20th of January, will finally reach its target and have a resumption rally that takes us up to the end of the month. So the bottom line is we're still expecting a low point, probably the next day, maybe Sunday or Monday, and a bounce into the late part of January, potentially as late as the 30th of January, okay, which is a little different than our last forecast. We located a 6.6 month cycle and the 4.2 month cycle. Both are giving us clues as to what's likely to happen on the short term. It could conceivably have an up and a down and an up in it. In other words, it may not go straight up. Until the end of the month, we're looking for a rally this week, probably with a high around the 16th, and then a dip, potentially a dip into the 20th right before the inauguration, and then a rally after the inauguration, which is different than what we thought initially, up until the end of January. And then in any way you slice it, it looks like the market's going lower in February and into March, eventually into May of 2025, which is in line with our original thinking. Now, what we're looking at there, several patterns emerge. One of them, of course, is the 147-week cycle. And as you can see, that one has a rather sharp rally starting next week. We don't necessarily expect that dramatic a rally, but we do expect a rally. So it's a little bit early to go short this market. It's a little dangerous. And we're also looking at a 62-month cycle, which is a multiple of our 260 trading day cycle that came out at the end of 2018. And that pattern is also repeating. And that market made a 20% break before the end in March. Okay. Now, we may not see 20%, but we're probably going to see more than 10% before this is all done. The next thing is that we were looking at a harmonic of a 11.5-year cycle. 3 of those is 34.5 years ago, and that came out with a high in July of 1990, and that had a big break. And that break would line up with the end of January, matching the end of July 1990, and it has a very nasty decline also for about a month and a half. Okay. We're expecting the second half of the year, potentially over the summer, to have one restorative rally, which could actually make new highs, believe it or not. So I don't think the bear market has started, although the December 5th high of 2024 is very important, and it's probably not going to be broken for a while. Okay? The January rally, if it resumes as expected, will come close, however, to retesting that high potentially. And if not, at least to go 2/3 of the way back up to the high. So it's probably meaningful enough to be alert. Such a thing could happen. We want to shake out the shorts, which are right now starting to build. The put-call ratio is ridiculously bullish at the moment. Okay, this is primarily for the swing traders, and it's also necessary to understand that there are multiple cycles always moving around in the market, and they're like water. You know, it's hard to pin down exactly where all of them are, and you have to consider the configuration of all the different combinations of cycles. We use cycles that are basically not the traditional sinusoidal waves that people are usually looking at. We're looking much more in line with Gann's knowledge and what Dr. Boomerang taught, 1987, 88, when I was one of his students. Okay, I think you'll find this extremely refreshing, given it actually works. We're looking at having our Trade Forecast Mastery course starting this coming Sunday, a week from today, the 12th. It starts on the 19th of January. We have a great group. I've already gotten a number of very, very talented people coming into this course. It'll be very good interaction. I also want to tell you what's in the course for those who are new. We have our primary tool is the forecasting. We teach people how to forecast the market. And along with doing so, we also add in 2 mechanical trading techniques, which are part of the course, and they're easy to use and they don't require the forecasting. And also, just for your information, because what we do is a timing system, we have located several timing models that are extremely accurate, at least have been in the last 10 years, where every month there are several time points where if you buy at that time, you buy an S&P futures at that time, you can go for a $500 profit with over 95% probability of winning. This is one of them. This is the strategy performance report over the last 10 years. It has 1 losing trade and 102 winning trades. Okay. So anyway, we have a lot to offer, and we enjoy educating people on how the market actually does work.